Amish families do not have credit scores. They do not carry health insurance. They do not have pay stubs from an employer. And yet banks that lend to Amish communities report they have never lost money on a single loan. Here is exactly how that works. Why an Amish family needs $100,000. The most common reason an Amish family needs a large loan is land. In Lancaster County, Pennsylvania, farmland sells for $10,000 to $20,000 per acre. A modest 20-acre farm costs $200,000 or more. Even in less expensive settlements, a family establishing its first farm needs significant capital. A son marrying at 22 cannot save enough by that age without help. The $100,000 loan is not extravagance. It is the minimum required to begin an independent Amish life on a working farm. The 4 sources of Amish borrowing. When an Amish family needs $100,000, they do not go immediately to a bank. They work through a specific sequence of sources. The first is family. The second is the community loan fund within the church district. The third is the Amish Mutual Mortgage Fund. The fourth is a local community bank. Each source is approached in order. The family exhausts internal options before seeking external financing. Family lending first. The father has been saving toward this moment since his son was born. Amish fathers understand their financial obligation to establish each child in an independent household when they marry. He provides the money not as a gift but as a loan with informal terms. No interest in most cases. Repayment expected when the son's farm becomes productive. This arrangement is not documented in legal contracts. It is a family agreement honored through the same cultural values that govern every other Amish financial commitment. Whatever remains after family resources are exhausted moves to the next source. Community loan funds. Many Amish church districts operate informal community loan funds. Wealthy members invest savings into a communal fund administered by trusted church members. This fund makes loans to young families needing capital for land purchases or business establishment at below-market interest rates with flexible terms. The Geauga Amish Loan Fund in Ohio is one documented example that makes loans specifically to enable members to acquire land supporting family farm formation. The fund's administrators know the borrowers personally and assess character, work ethic, and family reputation rather than credit score. A young man whose father is known as hardworking and honest benefits from that reputation when the fund considers his application. The Amish Mutual Mortgage Fund. The Amish Mutual Mortgage Fund is a church-controlled organization in which Old Order Amish members invest funds that are channeled to borrowers within the community for residential real estate loans. It functions as a private mortgage market that operates entirely within the Amish community without connection to mainstream financial systems. Investors in the fund are Amish community members who have savings to deploy and prefer to invest them within the community rather than in outside financial instruments. Borrowers are Amish families who need mortgage financing for farm and home purchases. The fund matches investors and borrowers at rates that benefit both parties more favorably than outside market rates would allow. The fund's administration ensures that loans go to borrowers whose commitment to the Amish way of life is genuine and whose church standing is solid. A borrower who leaves the community after receiving a fund loan faces social pressure from the entire community to honor the obligation before departing. The fund has operated for decades and serves as a critical financing mechanism for Amish families in settlements where land prices have risen beyond what family savings and community funds alone can cover. The local bank option. When internal community sources cannot cover the full amount needed, the Amish family approaches a local community bank. In Lancaster County, the Bank of Bird in Hand was founded in 2013 specifically to serve Amish and surrounding rural communities. It operates with an understanding of Amish financial circumstances that larger regional banks lack. The bank's lending officers know that Amish borrowers do not have W-2 employment income. They assess farm income, business revenue, and asset holdings instead. They understand that an Amish family's balance sheet looks nothing like an English family's balance sheet, and they have developed underwriting criteria that capture Amish creditworthiness accurately. Univest Bank, another Lancaster County lender, has also built a significant Amish lending portfolio. Tom Jordan, the bank's market president, has stated publicly that his institution has never lost money lending to Amish borrowers. This track record reflects not just the individual borrower's reliability, but the community backstop that stands behind every Amish loan. The bank knows that even if an individual family encounters financial difficulty, the community will mobilize to ensure the loan is repaid. Qualifying without insurance or credit score. The Amish borrower presents lenders with a qualification profile that defies standard underwriting criteria. No credit score because they do not use credit cards. No homeowner's insurance because the church community self-insures through mutual aid. No health insurance because the community covers medical expenses collectively. No employer verification because they are self-employed farmers or business owners. Standard bank underwriting software rejects all of these. Local community banks that serve Amish populations have developed workarounds for each obstacle. In lieu of homeowners insurance, lenders accept a letter from the church district confirming that the community will rebuild or repair the property if it is damaged. This letter functions as a guarantee backed by the collective assets and commitment of the entire church district. In lieu of a credit score, lenders accept tax returns showing farm or business income, property ownership records demonstrating assets, and personal references from church leaders who can attest to the borrower's character and financial history. The system requires more manual underwriting than algorithmic lending, but the results justify the effort. Amish loan portfolios at community banks consistently outperform conventional loan portfolios on every measure of credit quality. The Bishop's Letter. The Bishop's Letter is one of the most unusual documents in American banking. When an Amish family applies for a loan at a bank that requires homeowners insurance, the bank cannot simply waive the insurance requirement without violating federal lending regulations. The solution developed by lenders in Amish communities is the Bishop's Letter. The bishop of the applicant's church district writes a formal letter to the lending institution stating that the district's mutual aid system will cover any losses to the property that would normally be covered by commercial insurance. The letter effectively substitutes community self-insurance for commercial insurance in a form that satisfies federal regulators while respecting the Amish theological objection to commercial insurance products. The letter carries genuine weight because it is backed by the collective assets and commitment of an entire church district. If the property burns down, the district will rebuild it. This has been demonstrated repeatedly in Amish communities where barn fires and house fires are responded to with immediate community labor and material support that replaces what was lost faster than an insurance claim would have. Resolved. The bishop's letter is not a workaround or a loophole. It is an accurate description of how Amish property protection actually functions. Repayment culture. An Amish borrower who fails to repay a loan does not simply damage their credit score, they damage their standing in the church community that backs their loan. They damage their family's reputation across a district where everyone knows everyone. They damage the ability of future Amish borrowers to access credit at favorable terms. The social consequences of loan default in an Amish community are far more severe than the financial consequences of a credit score reduction. This is why banks that lend to Amish communities have never experienced losses. The community does not allow default to happen. If a family encounters financial difficulty that threatens their ability to repay the church, Deacon visits district households and collects contributions to help the family meet their obligations. The community absorbs the temporary hardship collectively rather than allowing an individual family to default on an obligation that reflects on the entire community's trustworthiness. Wealthier community members who hold informal mortgages on younger families' farms apply quiet pressure when payments fall behind. They do not sue. They do not foreclose immediately. They visit. They counsel. They restructure the payment arrangement. And they make clear that the obligation must be honored because the community's collective reputation depends on it. What Amish never borrow for. Understanding what Amish families never borrow money for is as revealing as understanding what they do borrow for. They never borrow for consumer goods, no loan for a new sofa, no financing for a kitchen appliance. No credit extended for clothing or food or any item that does not produce a return. They never borrow for vehicles because they do not own vehicles. They never borrow for education beyond the 8th grade because they do not pursue higher education. They never borrow for medical expenses because the community covers those through mutual aid. They never borrow for vacations or entertainment or any of the categories of consumer debt that consume the financial lives of English families at every income level. The only legitimate reason to borrow in Amish culture is to acquire productive assets, land that will generate farm income, a building that will house a business, equipment that will increase productive capacity. Every other borrowing need is met through savings, family support, or community mutual aid before a loan is ever considered. The result of this discipline is that when an Amish family does take on debt, it is always for something that generates the income to repay it. The loan and the asset are matched in a way that consumer debt never is. The farm pays for itself. The furniture shop pays for itself. The borrowed money produces more money. And the loan is repaid early because early repayment is a point of family pride that the community notices and respects. When the loan becomes a burden, even the most reliable Amish borrowers occasionally face circumstances that make repayment difficult. A disease outbreak that kills the dairy herd, a crop failure from an unexpected late frost, a medical emergency that consumes the cash reserve set aside for the next loan payment. These events do not excuse the obligation, but they do trigger a specific community response. The borrower goes to the church deacon first. He explains the situation honestly and completely. The deacon assesses whether the difficulty is temporary or structural. If temporary, the deacon visits district households and collects contributions that carry the borrower through the difficult period. If structural, the deacon works with the family to restructure their approach to the farm or business that generates repayment income. He may bring in experienced farmers from the district to evaluate what is going wrong and recommend changes. He may arrange for community labor to help the struggling farm increase its productivity. The lender, whether family, community, fund, or bank, is informed of the situation and asked for patience while the community works to restore the borrower's capacity. Banks that have established relationships with Amish communities understand this process and extend patience accordingly. They know from experience that the community will resolve the difficulty and the loan will be repaid. The patience is always justified. The loan is always repaid. The community's collective commitment to honoring financial obligations has never been broken in the documented history of Amish lending. What happens when the loan is paid off? The day an Amish family makes their final loan payment is a moment of significant community recognition. The family tells the church deacon. He mentions it during the fellowship gathering after the next church service. The community acknowledges it not with a party or a celebration, but with the quiet satisfaction of a collective obligation fulfilled. The father who provided the initial family loan receives his final payment, and the relationship between father and son shifts subtly. The son is no longer financially dependent on his father in any way. He owns his land outright. He owes nothing to anyone. This independence is the goal the Amish financial system is designed to produce. A family that owns its land free and clear can survive almost any economic disruption that the outside world generates. Market crashes do not take their land. Inflation does not take their land. Unemployment does not take their land because they are their own employer. The paid-off farm is the foundation of everything else the family will build. Their children will grow up on land that belongs to their family completely. When those children marry and need land of their own, the cycle begins again. The father who paid off his loan becomes the father who saves for his children's land. The community that backed his loan becomes the community that backs his children's loans. The system perpetuates itself across generations because every family that successfully repays its debt becomes the next generation of lenders and guarantors for the families that follow. What happens when an Amish family needs a $100,000 loan is a demonstration of a financial system that operates by entirely different rules than the one most Americans live inside. The family does not go to a bank first. They go to their father, then to the Community Loan Fund, then to the Amish Mutual Mortgage Fund. Only after exhausting every internal source do they approach a local community bank that has spent years developing the expertise to underwrite Amish borrowers accurately. They qualify without a credit score through character references and income documentation. They satisfy the insurance requirement through a bishop's letter that substitutes community self-insurance for commercial coverage. They repay reliably not because of legal obligation alone, but because the social consequences of default in their community are more severe than any credit score damage.